London Stock Exchange, a cornerstone of financial history dating back to the 17th century coffee houses of the Square Mile, has grown into an internationally recognized institution where countless companies seek to raise capital by listing shares, selling stakes to both corporate and private investors. But here's where it gets controversial. Despite its storied legacy, the LSE might be facing a profound crisis that could threaten its relevance in the modern financial landscape. Recent observations highlight a worrying trend. Companies are choosing to delist from London or relocate their listings to other markets, notably the United States. Simultaneously, the number of new companies going public in the UK has dropped significantly. Last year alone, the market lost 88 firms, marking the highest decrease since the tumultuous days of the 2009 financial crisis. Meanwhile, UK pension funds are shifting their investments away from domestic stocks, with only 5% of their assets now allocated within the UK. This isn't just a dip, it signals a potential long-term decline. So what's behind this unsettling pattern? Several factors are often pointed out. The impact of Brexit is frequently cited, along with regulatory policies that are perceived as more cumbersome compared to those in the US. Additionally, the stamp duty tax on share transactions makes trading more expensive, discouraging investors, while private equity firms are increasingly taking over companies, further reducing public listings. A core issue appears to be liquidity. Markets that are active and easy to trade in support a healthy, vibrant environment. Sadly, London seems to lack this liquidity, making the city less attractive for investment. At its core, the problem also seems rooted in valuation. US markets tend to assign higher values to companies seeking capital, offering better prospective returns for investors. When UK companies receive lower valuations, they are more inclined to look abroad. This scenario fosters a cycle where private equity takeovers thrive, further weakening the public market in the UK. Some voices suggest that the traditional model of finance rooted in London's historic city may have fallen behind. Liam Byrne, chair of the House of Commons Business and Trade Committee, remarked this week that the London Stock Exchange is no longer the engine of growth it once was, pointing out the need for a new financial architecture suitable for today's economy. An inquiry is now underway to explore what a revamped investment ecosystem could look like. But how significant is all this for everyday people? Many might think that the global nature of markets and the high-stakes world of corporate takeovers and speculation have little bearing on their daily lives. Yet, they can be more intertwined than it appears at first glance. A declining or relocating market can mean fewer jobs in London's financial sector, which affects a wide network of professional services, lawyers, bankers, accountants, and consultants, that contribute significant tax revenues to the UK Treasury. Moreover, the broader economic impact is substantial. The presence of important publicly listed companies enhances the UK's standing on the global stage, attracts international investment, and links the UK to vital supply chains that drive innovation, productivity, and job creation. David Bailey, a professor at Birmingham University, summed it up earlier this year. If London isn't seen as a top choice for major companies to list their shares, it raises serious questions about whether UK businesses can successfully attract the investment they need to grow. This directly influences government ambitions for economic growth and ultimately affects all of us. So what's being proposed to turn the tide? Several reforms are in progress. In her recent speech at Mansion House, Finance Minister Rachel Reeves highlighted initiatives aimed at simplifying trading rules, establishing a task force to attract more listings, rolling back overly restrictive regulations, which she argues have gone too far in trying to eliminate risk, and offering targeted support for innovative sectors like fintech. Interestingly, Reeves has resisted the city's demands to abolish stamp duty on share transactions, which still generates around £4 billion annually for the Treasury. A key part of the government strategy is persuading pension funds to invest more domestically, supporting British businesses and infrastructure projects, and encouraging the wider population to participate more actively in stocks and shares. For example, a revival of the Tell Sid advertising campaign from the 1980s, famously designed to encourage British citizens to buy shares during privatisations, is being considered. The hope is that increased pension fund investment at home will energise the market, boost valuations, and provide higher returns for savers. Additionally, since only about 23% of UK individuals directly invest in stocks, compared to nearly 66% in the US, there's a substantial untapped potential. A new marketing effort aims to educate Brits on why investing in shares can be beneficial, potentially unlocking hundreds of billions in savings sitting in low-yield cash ISAs. Of course, opinions differ on whether these measures will be enough. Some experts argue that the UK's flagship market still remains one of the largest and most liquid globally, supported by deep pools of capital and a trusted legal framework. Last year, the FTSE 100 hit record highs and regained its position as Europe's biggest stock market, overtaking Paris. Plus, there's a sense of optimism that London might benefit from investor hesitations in the US, with some city insiders noting an increase in international investors returning to the London market, along with a robust pipeline of deals set to further boost activity. Yet, challenges linger, particularly around fostering high-growth, innovative companies. Liam Byrne pointed out that many of the UK's brightest entrepreneurs struggle to secure the finance necessary to scale their startups into global giants. The recent departure of online payments firm Wise to a listing elsewhere, in a move valued at around £12 billion, underscores this difficulty. Finally, it's worth recognising that the stock exchange's giants, primarily earning revenue abroad, do not fully represent the UK economy's health. More widespread public engagement with the stock market could help, but change requires broader efforts. London's Business LDN advocates for more infrastructure investment, training and devolution to empower the city to lead innovative projects and support UK-wide growth. Some experts suggest focusing more on supply-side reforms, building homes, improving transportation, and developing energy infrastructure as a way to foster sustainable growth instead of just tweaking financial markets. The question remains, can these reforms and strategies truly revitalise the London Stock Exchange? Or are we on the cusp of a fundamental shift that might diminish the city's global dominance? Share your thoughts. Do you believe in the potential for a comeback? Or is this decline an inevitable consequence of a changing financial world?